All right, y'all. Austin Bratton here with Guild Mortgage. I'm here to answer your mortgage questions and help you make the right move for your family. Today, we're going to be talking about converting your primary residence into an investment property so that you can move up or move down into that next chapter of your life. The first thing to discuss is going to be that down payment. How are we going to get that down payment on your next property? Now, if we don't have the cash on hand or we can't get a gift from family for that down payment on the next home, then we're going to need to tap into the equity on your existing property. There's two ways to do that. The first is going to be with a home equity line of credit or a home equity loan, which is where we're putting a second mortgage onto the property to tap into the equity. Or you can do a full-fledged cash out refinance, for example, and refinance the whole note, if any, on your current home and tap into that equity again so you have that down payment for the next property. Right now, the home equity line of credit and home equity loan options are the most popular because a lot of people have these like shiny 2 and 3% interest rates that we got during the COVID clearance sale on mortgages. And as such, nobody wants to give that up, especially if you're going to turn it into a rental property, because let's be honest, you want this thing to cash flow if at all possible. So say we take out a home equity line of credit and we've tapped into $50,000, $100,000, whatever, for our down payment on the new home. Great. Well, cool. Now we're going to be stuck with 2 mortgage payments. The good news is we can offset your existing mortgage with a rental agreement, either by getting a lease agreement set up or doing a market rent survey. If we can determine how much your current home would rent out for, then we can use that either as income or at the very least to zero out the expenses on that loan. Some loan programs with federal guidelines specifically don't allow you to use it as income unless you have a history as a landlord for at least a year. Other restrictions apply. For example, with the VA, if you're purchasing with the VA loan, the VA is going to have reserve requirements for the home that you are departing. So you might need to have 3 months of reserves for the home you're leaving behind, might be 6 months depending on the loan program. So we want to make sure that on that next purchase, you are keeping enough money back just in case you don't get that home rented out right away, that you're not going to be stuck dipping into your actual savings or going under while you're waiting on that tenant to kick in. With FHA, they have some interesting guidelines where you can actually leave an FHA loan and go purchase a property with another FHA mortgage. However, the restrictions on that get real particular really quickly. For example, you have to be relocating for work or for family reasons. You have to be going a distance of 100 miles or more. And again, you still have to be able to meet all of the other requirements of a fair market rent survey, a lease agreement, and required reserves for the property that you're leaving behind. The good news is we don't have to have a renter move into your property right now because, well, you're living there. So on a pre-approval, while you're out there shopping for a mortgage and getting pre-approved to make that next move, you are going to be setting this up subject to and assuming you're going to be able to rent out this property for X amount of dollars. And that's what your pre-approval is going to be based on for your next home. It's going to be based on, hey, we have a renter lined up for as soon as we move out. They're going to be paying us X amount of dollars per month. Or we get in contact with a property management company and they're able to do a rent survey for you, or we do an appraisal is the other option. We do an appraisal on the property and find out through a verifiable third party, hey, this is what this home would sell for. And we're going to do your pre-approval subject to and assuming you're going to be getting this rental income coming in. Now, the last one that really trips people up, and this is a big one, is you have to wait at least a year after moving into the property unless you have a very good reason. Why is that? That's because when you purchase a property as a primary residence, you're effectively signing a contract with your note stating you will live there for at least 1 year. That's why all these social media influencers say, hey, move in, and then after a year, ta-da. It's because of these federal guidelines that state you are signing a contract and you got to stay in this home at least that long. Most organizations aren't going to be willing to write 2 primary residence mortgages for you. So it's important that we either have a really good story, like relocating for work, for example, to the other side of the country, or that we're waiting that 12 months to make the underwriting process easier for you. I'm here if you have any additional questions or if there are specific mortgage and real estate subjects you would like me to cover in future videos. Thank you.